Let's continue with our debt ratios. We talked about the liquidity ratio and the assets to debt ratio. Now let's talk about the debt to income ratio. And sometimes this one is called DTI. And this one is going to be our annual debt payments divided by annual gross income. And what this one is telling us is a person's indebtedness relative to their income. And so this is a percentage. The result is going to be a percentage of someone's income that is consumed by debt. So it's the percentage of your client's income that's going to make their debt payments. And so depending on what it is they're trying to do, particularly for mortgages, there's certain levels of debt that it's ideal for them to stay under. So for example, when we get into talking about mortgages, we'll talk about front end ratios and back end ratios, but on the front end, which is just the debt excluding the mortgage payment, we want this to be less than 28%. So oftentimes when we're looking at debt to income ratios, just to kind of put it in general terms, obviously the lower the better, because we really don't want to have any credit card debt, but at least we'd like it to be less than 30, less than 20%. So we know if we get them under 28%, they will have a better chance of qualifying for a mortgage. Let's look at one more debt ratio, and this is debt payments to disposable income. And so that's going to be a little bit different because we're not looking at all of their income. We're just looking at basically that income that's not committed. And so this is going to be the monthly non-mortgage payments divided by monthly disposable income. And so similar to the debt to income ratio, this is telling us what percentage of your client's income is going to debt payments, but now we're being a little bit more specific and we want to know what percentage of their disposable income is going to those debt payments. And then lastly, we talked about solvency already, so let's just throw in a solvency ratio. And so our solvency ratio is total net worth, and we talked about that when we did the net worth statement, divided by total assets. And so remember, solvency was a measure that we looked at on the net worth statement that told us whether or not assets were greater than debt, which is ideal. So if assets are greater than debt, we're solvent. If assets are less than liabilities, then we're insolvent. So what this solvency ratio is telling us is how susceptible we are to bankruptcy. Because remember, we said in the long term, insolvency is not sustainable and it leads to bankruptcy because you can't pay your bills. You just don't have enough assets to cover your liabilities. And so this solvency ratio tells us how vulnerable your client is to bankruptcy because of the ratio of net worth to assets.